Hi everyone, welcome to the presentation for the market outlook for the next year and the next 5 years. My name is Blaž Hribar, I come from Ljubljana. I'm a board member in a pension fund company Pokojninska družba. My primary responsibility is asset management. I'm doing this for the last 10 years, and prior to that I was head of analysis in the biggest mutual fund company in Slovenia. So I have over 20 years of experience firsthand on asset allocation and investment in general. So let's start. So let's start with past returns. So how was the past? And basically it was very good to us. We had fantastic 15 years in the world. So as long as you were invested in equities, basically everywhere in the world, and especially in the Western world, the returns were great, if not fantastic. So for the last 15 years, so since 2009, the last bottom on the stock exchanges around the world after the global financial crisis, in 2007, 8, and so on. So since 2009 till today, 14.3% per year. So every year is the return that you achieved if you invested globally in diversified global index. So that is far above the historical norm, which is around, so if you look last 100 and something years, 200 years, depends what you look at, but the numbers are similar. Something around 9% is a general good estimation of a historical return in stock investing, diversified stock portfolio investing. Of course, you can be above that and below that, but for the last 15 years, a period of 15 years with almost 15% per year returns is not normal in historical terms. And why was the return so high? So what was the driver of this stock equity performance? So what is the basic reason behind it? I would say it was a great period of economic growth. So we went from a global financial crisis and we gradually recovered towards 2020 and then on forward. So globally we had lower unemployment, we had higher basically growth and good times in economic sense. That's one reason. But within that we had great difference between different regions and especially sectors, I would say. So on this chart we can see, for example, that Europe, MSCI Europe index, equities from Europe returned quite nicely in these 15 years. So from 10 euros it went up to 500 euros if you reinvested the dividends and waited for 15 years. So from 100 to 500, not that bad. That's 10% plus, which is very good from the historical perspective. If you go to the world, so if you went into the world index, so where also the Northern America and emerging markets are present, you received 14.3. Already said something about that. 14.3, a great number. Where did it come from? Not from Europe. It came from the United States, from the America. Basically, all of the excess return came from one sector which is called information technology and technology in general. So some companies that are not strictly information technology, so not software or hardware per se, but consumer-driven, consumer-oriented, but the technology behind it is basically smartphone or internet or all of that. So technology was the driving force behind extra return that we have received in the last 15 years. So how did that develop? That basically developed through a couple of, I would say, technology advancements and I would say enthusiasm for the new technology. It all basically started quietly with cloud infrastructure. So in 2015, around that year, cloud became something that IT departments and the IT industry got very excited about. Started the transition, revenue came, profits came, so also the analysts, everybody else, like people like me, noticed the sector that something is happening. That was the first time after, I would say, .com balloon popped, that the IT sector received again attention of the general analytical public, I would say, professional public. Then it went on with smartphones, with iPhones, with Android phones, with apps. Consumer got engaged with all the digital that this world could provide. So that added enthusiasm for the IT sector. Then of course we did get Bitcoin, we did get crypto. That additionally focused the attention to the IT sector in general, and it provided interesting, I would say, topics that IT sector could engage with. So basically computer power, all that was always needed in all of these years, increased. So a handful of companies were able to provide it, and they were the ones that basically had stocks that grew in value. And of course, lately, since 2022, we have ChatGPT, we have AI. So artificial intelligence is something that got the attention of the whole world. And of course, the stock market did notice that and did reward that. So AI is basically now the general theme that is driving extra returns. If you look at the companies that moved a lot on a certain day, it's almost always these days about AI. And the technology sector got really big. So today, basically, when you buy S&P 500 index ETF, you basically are buying technology. Half of that money goes to technology companies and companies like Amazon, Netflix, Tesla, Google, and Facebook, Meta. So half of the money, if I'm exact, since yesterday it was 48.56%, goes into IT and IT-like companies, consumer-driven, consumer-oriented companies. So that is huge concentration of one thematic investing, one kind of, I would say, story that is dominant in the market. That is not often. That is only a couple of times in the past, in the last 200 years, something like that has happened. And it always was connected with high valuation, high enthusiasm, and so on. So times like today have happened before with a different, I would say, technology. And when you look at these metrics, these times are no different, are extreme enthusiasm for a certain new technology, and a lot of money, huge amounts of money are flowing into that technology. This time it's AI. In the past it was internet, .com, going further back, whether it was aviation, trains, electricity, different, I would say, machines and things like that help our humanity on an everyday basis. So truly transformative technology always gathered attention and money, and this time it's not different. So I have already said a little bit of why everything is a bit, I would say, concentrated, specific in these days, in these months. But my question basically was, when I'm doing an outlook, I'm always trying to find some base from which to think whether stocks are expensive or not. And through years, I have found it very useful to look at cyclically adjusted PE, which means simply PE, but it looks at a profit per share from a 10-year perspective. So it takes last 10 years of a profit of a certain index. In this example, it is S&P 500, and divides with the current price. So it basically says that stocks today in the United States are extremely expensive if you think that the profit for the last 10 years will be something that will repeat in the next 10 years. So if the profit will be the same, then stocks are expensive these days. Only once in the past was this metric more extreme, and it was at the height of the dot-com bubble. So what to say? From that point of view, yes, stocks are expensive unless there is huge jump in profits in the next couple of years. Okay, so whether we need to have high profit growth in the next couple of years, or prices have to go down back to the more neutral level. That was always the case in the past. So it was in 29, it was 2000, it was in 66. So it's a bit scary to look at this that way. So you have to be a bit of enthusiastic. You have to basically believe that the profit will come. So where could the profit come from to justify these high prices? That is the next question I think we need to ask ourselves. So basically, let's start by looking how expensive these stocks really are and how much profit growth is basically included in today's prices. So as we see, the Magnificent Seven are the stocks that are usually talked about. So here we can see the stocks, so Nvidia, Microsoft, Apple, Google, Amazon, Meta, so Facebook and Tesla. And we basically see that PE ratios are high, but not extremely, I would say, high. So we have something in the 30s. If we look at Nvidia, 50. If we look at Tesla looks excessively expensive. So from that point of view, they do generate high profits already, but the price for the future profits is I would say, high. So a certain growth in profits has to come. Okay, so here are two problems basically then. You have to believe that the profits will come, and you have to believe that they will be sustainable. So in order to do that, at least main part of the AI story has to become truth. So it has to become capable to solve problems in every day for companies and for consumers. And they have to be able to charge for that. Okay, as for now, most of these applications are free or really almost free. So it's not generating enough revenue. And of course, these companies are AI companies, specific AI pure play companies like OpenAI, DeepSeek, and others are obviously not profitable and will not be in the foreseeable future. So not in the next months, not in the next years probably. So there is the problem. When will these AI services basically become profitable so that these Magnificent Seven companies will be able to say, we're going to get our money back for investing huge amounts in data center capacity, for chips, for buildings, and for the electricity that these power-hungry data centers are now consuming. So it's a huge, I would say, undertaking, not only to build it, not only to create AI services, but to make them profitable. And on that part, on the second part, it's easy to build, it's hard to build with profit something, right? So it's gonna be a challenge. And I do believe that they have a problem on their hands. So there is a risk to risk. The main risk that I see is that AI doesn't deliver the profits that they are promising. So the AI will be great. It's entertaining. It works. As long as the knowledge base is public, AI can gather that knowledge and give it to the consumer in a very effective way. So it's a great invention. But in order to have these kind of valuations, to deserve these valuations, to deserve these huge amounts of investment, they will have to be something more, a lot more. They're promising us that, but the problem with technology and with investing in new technology is that the time horizon is unclear. So when will the technology be mature enough to provide that profit? That is the question. So for now, the main investors in AI startups and AI infrastructure are different VCs, so venture capitalist funds and private equity money from around the world. The problem is if the AI doesn't provide the profitability fast enough for these investors, the revenue doesn't grow enough, the profits don't come, then the problem is how to finance all of that. And then the money starts flowing in the wrong direction, and then the valuations tend to fall apart. So that is my question. How fast will the AI industry reach that break-even point of profitability? And that is, I believe, a big risk, that it will not be soon enough for those that are financing the AI build-out today. That's the major risk that I'm afraid of. Next risks are stated here are the usual suspects. Whether it's Mr. Trump, American president, and his tariffs, America has the biggest, United States have the biggest tariffs in the last 100 years, around 20%, if I'm correct. So that's a huge difference. So it creates problems. It creates onshoring, but it creates also less trade. It creates problems for American consumers. Inflation risk is something that it creates. It's a lot of talk goes into that. For now, relatively low effect of tariffs on inflation, but through time, more and more of that effect will flow through to prices. So consumer is very sensitive to prices, to inflation, and if something goes wrong, it could go really wrong. So the basic, I would say, economic situation that we're in and that we are expecting in the United States is basically stagflation, and something similar in Europe and the rest of the Western world. So everybody has some sort of tariff or trade barrier now, so it creates problems or decreases the global trade, which increases the prices, which increases the cost for the consumer, which decreases, I would say, exports. So you have a bit of a price increase, and you have lower supply, less goods on offer, and lower export. So it creates stagflation, basically. Stagnation in the economic sense, and it increases risk of inflation also. Geopolitics, every day is different. We have a huge, I would say, huge gap between the Western world and the new, let's say, the new Asia with Russia, India, and so on. So there are a lot of conflicts. If something goes wrong, it could go wrong. It could really go wrong, and it wouldn't be good for the stock markets, and within that, of course, it wouldn't be good for the technology companies. So as I said, the financing, for example, for the AI build-out in the United States is coming in really large part, for example, from the Arab Peninsula, from the Saudi Arabia, Qatar, and so on. So these connections are not, I would say, something that cannot be altered or changed or weakened. So that is my concern. So we have, and the next problem that we have, I would say, is fiscal spending. Our leaders in the world today are not those leaders that were 10 years ago. 10 years ago, we were talking about austerity, saving money, not spending money, not investing. All of us were savers at that time. These days, everybody's talking about spending. So we have programs like Rearm Europe, which means let's give a lot more money, let's invest into defense capability of Europe. Then we have energy investments. It doesn't really mean that we need a lot more of those investments, but we want to be self-sufficient. So we're giving a lot of money, and we're not really considering whether that will prove profitable or not, but we just want to be more safe and self-sufficient. And then we have onshoring also in that context. So it means we're bringing manufacturing closer to home. That, of course, means basically overheating. It could be overheating if it is in huge numbers, and if it is together with fiscal spending, budget deficits, and other I would say, financing that is not that secure in long term. So we are seeing already problems, for example, in the United Kingdom, where they have a political crisis. So we see that the yields on long-term bonds are notably higher. So it's getting higher. I mean, it's getting pricier to refinance the government debt and every other English debt. And we have seen the same dynamics we have seen in France. So it's a budget deficit that's not low, and a fiscal spending that is projected to increase, and a political crisis. So all that together increases the yields or increases the risk premia. So things like that can create fires that spread to other areas. So it's hard to say what will be the thing that will deflate the technology bubble, but anything that basically goes wrong can be something that starts the avalanche that at the end basically re-rates, so basically lowers the valuation of the equities around the world. So I would say there are plenty of risks, and there are plenty of promises and forward revenue forecasts and some things like that. So there's a lot of I would say belief in what AI and technology will do in the future, especially profit-wise. So we are a bit skeptical, quite skeptical if I'm honest. So we are careful not to over-allocate to the risky part, in our opinion, the risky part of the equity market, which is basically the technology and the AI story. We are invested, of course, but we are not over-investing. We are not overweight this sector against our benchmarks. We are slightly underweight, and so far, basically, we had good luck, and we have good returns. We had the big names, and so far the big names are the ones that have profited the most, and we hope that continues, but we are basically careful. So as far as outlook goes, as I said, we are careful. Every time that in the history of stock markets, when you had new technology, enthusiasm for that technology, when you were on economic peak, and when you had high valuation and high past equity returns, far abnormal for long-term stock investing, that was a dangerous period in the stock market history. And sooner or later, most of these bubbles ended, whether deflated slowly and then suddenly or bursted in short periods of time. But basically, in the short term, we do see high momentum, and we do see enthusiasm from investors for the AI story. So there is a high probability that in the short term, AI bubble has further to run. But as soon as I say that, I would like to point out that last couple of weeks and last days were basically full of examples that even these momentums have their limits, right? So when Oracle is issuing bonds to invest in data centers, when NVIDIA is investing equity into OpenAI, which is the main buyer of NVIDIA chips and so on. So we see problems in that kind of dynamic. We see basically these people are now doing things that are the extreme of how to get money, how to inflate the story. So we will see how further it can go, but we are not betting aggressively against the story in the next couple of days, weeks, or months. In the midterm, so let's say up to 5 years, sooner or later investors will demand profitability. So VCs, private equity, private investors, they will want to see profits from these AI startups. They will want to sell a startup to some strategic partner. And we do see a problem in that regard. So when the money starts flowing, the profitability should be there, and we are skeptical that there will be enough profitability in AI sector as a whole to justify the valuations that we have today. So we are, I would say, we are quite convinced that the AI bubble will deflate in the next 5 years, and we don't want to be on a wrong side of the dynamic. So in the long term, we have high valuation basically, and every time that you had high valuation in the past, you received lower long-term returns in the future. So we are basically saying that if the history basically will repeat itself, it seems like it's repeating. If not repeating, it's rhyming. So we do believe that the returns will be lower in the next 10 years due to high valuations today and also the demographic trends in the Western world. But that's another topic for another day. So we are careful not to over-allocate to the high valuations, and we are looking for alternative investments other than technology that might be in some sort of, let's say, growth story in the midterm. And we are basically quite fond of Europe. We are basically quite fond of European, I would say, reindustrialization. So industrials in Europe are something that we're looking at. Banks in Europe are something that we're looking at. We do see a fiscal push on a European scale into energy, into defense, into industrialization. And we do believe that banks will play a big role in that part. And therefore that banks and industrials are an interesting part of the European stock market. All in all, we expect lower returns in the next 15 years than we received in the past 15 years. How much lower? I would bet on a 5 to 7% per year, or 3 to 5% real return per year in the next 15 years, something that history can also confirm and align with. So that's basically all from me. Thank you for listening, and I hope you enjoyed the conversation and the presentation. Bye.